Hey guys, it's that Dividend guy coming at you with another Robinhood portfolio update. Happy Wednesday. Hopefully everybody's having a GGD, a great green day in the market. You know, I always wish the best for my viewers and subscribers. So for today, we're going to go over the overall portfolio value. We're going to go over the value by the metrics, as well as our buying power, dividends that are going to be coming in, the individual holdings and how they are performing, as well as the two stocks that are on my watch list, and what prices I want to purchase those companies at. So jumping right in for today, we're up about $73, up 0.13%. That 1 week mark, we are up around $970. That 1 month mark, we are up over $3,000 with a 5.88% return. That 3 month mark, we're sitting at $3,600, a 7.16% return. Then that year to date, we're at $5,600 on an 11.5% return. That 1 year mark, we are sitting at $12,867.27, a 30.54% return. And then all time, we are up $28,988.74, a 111% return since April of 2018. We do right now have a buying power of $99.74. That was just increased by Visa paying us a dividend of $20 and change. We also have Realty Income and Google paying us a dividend this month as well. So that will be, I'd say, a little over $100 by the end of the month, which is nice. And the plan for that is I could either use money on my next check to buy some more Google, or I could go ahead and buy Apple for this month. Keeping that goal alive of buying a share of Apple every single month. If I do that, as of right now, I believe I'll have around 20 shares of Apple by the end of the year. But keep in mind that I do want to focus on the current deals. And even though I want to have 20 shares of Apple, I'm okay with kind of sidelining that and taking advantage of anything that's a really good deal within the portfolio. So say Coca-Cola drops to 55 and my average cost is 57. I'm more likely to buy Coke than I am Apple, especially if Apple's price is a little higher than my average cost. So the point is, stocks fluctuate, right? And deals change every day. Stock market prices fluctuate. So it's important to not be too narrow visioned when it comes to the stocks you're buying, because you could miss out on some really good deals if you're focused on just one single position. So jumping in, starting off with Realty Income, sitting at $58.04. We've got 5 shares, $290 worth of market value. Average cost is right around $52 per share. 0.53% of the portfolio is in Realty Income. Today we're up $1.35. Total up $31 with a 12% return and a dividend coming in on the 14th. So in about 10 days of $1.34, which will put us above that $100 mark for dividends. But this is one of those that I do want to build up. I'm not going to be as focused on it as I am on Google or Apple, simply because the price is so high. I originally had it around the $50 mark in my original position, and as of right now, my average cost is $51. So I do want to focus more on Google right now, but I do want to build this position back up to that like 170 to 200 share count mark. Then we've got Altria down today at $56.12. We have 320 shares, right around $18K worth of market value. Average cost is $47.27. Almost 33% of the portfolio is in Altria. Today we're down $57. In total, we were up $2,800 with a near 19% return. So overall, I think what is happening with Altria, people are realizing that it's still profitable, it can still make money, it's still got brand power. There's a lot of positives behind the business. I think the Juul, debacle has really hurt the stock overall for the past couple of years, and people are realizing it's still profitable, it still has a great business, it still has great branding, so it's still recognizable. It's the #1 cigarette brand in the world. So I'm not worried about it long term. I just plan on using the $300+ that it pays me to buy a share of Apple every quarter. So that is 4 free shares of Apple every single quarter, as long as it stays below $300. So it's awesome that I'm able to use dividends to build the portfolio without having to add more capital. But if now I'm in a position where I can add more capital, then the positions will just grow a little faster. Next up, we've got Coca-Cola down below $71, 15 shares, $1,056 worth of market value. Average cost is $60.54. Right around 2% of the portfolio is in Coca-Cola. Today we're up $3.60. Total we're up nearly $150 with a 16% return. Guys, Coca-Cola has been pretty flat for me for the past, while. So I'm surprised that it's gained as much as it has. But with that PE ratio being, 28, it is still, I feel like, a little overpriced, but overall, it is one of the most recognizable businesses in the world. They have great profit margins. They have good cash flow. They have an untouchable brand loyalty when it comes to customers. So overall, I think it is a little overpriced, but you also have to put in those factors, and it's gonna trade at a premium because it's been such a consistent business. So I would probably buy it around the $70 mark if I didn't have such a low average cost. So for me, the highest I'd buy it at is probably like $64 a share. So I'm going to wait for it to drop a bit, but this is going to be one of the top 5 foundational stocks, those being Apple, Visa, Google, Coke, and Berkshire. So this is one of those that I'm going to wait until it hits a price that I think makes sense, and then I'll buy a boatload when I have the cash. Then we have Apple at $235.10, down a little bit today, about $1. 10 shares, $23.50 worth of market value. Average cost is right around $220. 4.28 or 4.3% of the portfolio is in Apple. Today we are down almost $12. Total we're up $160 with a 7.25% return. So guys, this one I'm not worried about adding more of. I'm literally just going to buy it every single month. So with the next paycheck, I want to transfer over the $240, $250 that I would need to have 11 shares. So by the end of March, I will have 11 shares of Apple no matter what. So I'm going to stay consistent with my strategy. And eventually, I'm going to have like 100 shares, and it'll be a pretty big position. And eventually, it'll be the biggest position in the portfolio. But just consistently adding to your favorite positions is important. Consistency is key. That's what really makes you wealthy, because if you sit on the sidelines for too long, you're never going to buy anything, and your wealth doesn't actually grow as fast as if you're constantly adding. So it's important when you have those like really big winners like AbbVie in my portfolio, or even like Coke or Realty Income right now. But if I get too attached to those prices, I'm never going to buy those quality businesses. So it's important to have a range of where you would be willing to buy it, because if you get so hung up on that average cost, you're never going to purchase those quality businesses again. And sometimes that makes sense, right? Sometimes, like Buffett's gone like decades without buying like any American Express or Coca-Cola because he's got such low average costs that he doesn't want to add to it. But Buffett also has 400,000 shares of those companies. So for smaller investors that can't obviously put 400 grand into a position, the consistency and over time, the average cost doesn't matter as much as the performance of the company, and the quality of the company will lead to better performance if it's a higher quality, higher growth, higher margin company. So I'm excited to add more Apple, and I'm hoping to have maybe a little bit more than 20 shares. We'll see. If once I get my tax return, I have my savings account where I want it. So just financially, I'm in a better spot than I was last year to be able to put more cash into the portfolio. And I'm super excited about that. Next up, we got AbbVie at $209.50, up $1.74 today. We've got 95 shares, $19K worth of market value. Average cost is $95.19. 36% of the portfolio is in AbbVie. Today we're up $165. Total, we are up 120% with a $10,800 gain in AbbVie. So guys, this is by far my best tree. I'm going to keep watering it by just letting it sit, right? I'm not adding at these prices because it's double my price, but my average cost. But I do use the dividends for more purchasing of a different stock. If AbbVie was around like $100 or $120, I'd buy it. But 200 is definitely one of those that like I feel like AbbVie's an exception to the like don't get married to your average cost rule, because of course the returns aren't as good as what Buffett has on like say American Express or Coca-Cola. But this is where this is a good thing, obviously, right? I've made a lot of money on it, but I also don't want to add to this position. So now what I'm forced to do is try to find an alternative investment that I think will perform as well or better than AbbVie, which is extremely hard to do. AbbVie's done very well, and I bought it at the correct time. And timing is impossible to get right. Like, this was complete chance. Like, I studied the deal that was going on with AbbVie and Allergan, but I looked at both companies and I said, together with this synergy of these companies, I think with just Humira and just Botox, which were the two big drugs that they had between those companies, I looked at the profitability of just those two drugs, nothing else, and I said, I think it should be worth this amount per share once everything is consolidated, like once everything is together. And my price originally for AbbVie was about 80, and I believe the 52-week high was like 120. I said I think it should get up to 170. So I'm obviously it's above where I thought, which is okay because of course both companies and the company now has made more drugs, has been more profitable, so I did predict the future correctly, which according to Charlie Munger, the best type of investing is when you can predict the future correctly with a couple of key companies and just sit on your ass because you predicted the future correct. So this is a solid candidate for why value investing works, because I've also had a coworker at another job tell me that they bought AbbVie, but they bought it and sold it, so they were constantly getting in and out. And they're like, I've lost money on AbbVie. I don't understand how you've made any. Well, I didn't sell the company 15 times, right? I bought it in like 2019. I guess we can go back and look, right? Because there's been dividends, but if I go all the way back down, yeah, I bought it in first shares was in 2019, June of 2019. So, if I would have bought it and sold it over the past 5 to 6 years now, I probably would have lost money on it because the stock price fluctuates. But long term, I believed in the company, believed in the management, believed in the pipeline as well for the drugs, and I've made over 100% of my money. So, to the people that say value investing doesn't work, it works if you do it correctly, right? And that's one of those things that I've wanted to do. There's been a couple more deals that I've looked at that I've done incorrectly, like Tyson Foods, VF Corp, and there have been a couple that I really could have made a good amount of money on, like Facebook. Facebook for me was a value investment play. It wasn't necessarily, I wasn't looking at it as a growth stock. I was looking at it as, the company's value is this. I think it's underpriced, and I should take advantage. But I did not. So that's the other important thing too. Is if you see an opportunity, you always want to have a certain amount of cash on the side to take advantage of those opportunities. But by far, AbbVie is my best investment, and that is the tree that's going. I think Apple's going to make me a millionaire first, just because that's the stock that I really do believe in long term, that I think is going to do it. But I would not be surprised if AbbVie over time outpaces Apple, and for me, for the price I bought it at, it makes me a millionaire. Then we got Visa at $352.59, 35 shares, $12,300 worth of market value. Average cost is right around $350 per share. We're on, there we go, Visa. Sometimes Robinhood does that where it doesn't actually switch over and it bugs out, but 22% of the portfolio is in Visa. Today we are up about $6, $5.95, and total we're up $165 with a 1.36% return. So guys, I don't know why it's doing that, but I definitely would be buying Visa. Really close to my average cost, and I think it is one of the best businesses in the entire world. And I have no hangups about it passing Apple as the biggest position in the portfolio, because I honestly think it could do it. Depending on Apple's sales with iPhones, people upgrading, just over the overall economy, just like people being able to afford something like a new iPhone. There are all these like factors that could affect Apple that I don't think affect Visa directly. Like even during COVID, like yeah, people spent less money, but people were still using Visa's payment network. People were still using Microsoft's payment network. Less people during COVID were likely to upgrade their iPhone, right? So that's where I think Visa might outpace Apple for me, because I just feel like there are less factors that could derail its growth versus Apple. Because Visa's not dependent on selling an iPhone at a higher markup. Visa is a payment network that they let people use their network and get paid fees for it. So I like their business structure better than Apple's, and I do think overall Apple's more profitable, but I do think overall Visa has more growth. And so I wouldn't be surprised if Visa does overtake Apple, and I'd be happy with that. Now, I do want to keep these relatively close in price, in market value, which just means I need to put a crap ton more money into Apple, which I plan on doing. But just overall, guys, I think Visa in this set of months is by far the best quality company. I've bought so many companies in this 3, 6, 9, 12 in this set of months. I've bought Tyson Foods. I bought T. Rowe Price. I bought VF Corp. I've thought about buying like Microsoft. There have been a lot of companies that I've just even looked into, but every single time that I wanted to purchase something else, like in my when I talked about it when I was like brainstorming it with a friend of mine, I said, you know, if I have Tyson Foods and it's at 70 goes, or it's at 40 goes to 70, I'll have $30 per share, and then I'll put $13,000 into T. Rowe Price, and then T. Rowe Price will be at 100, and if it goes to 200, then I'll double my money. That's $26,000 to put into Visa. So my end game for every position outside of Google, because I don't want to sell out of Google, I want to own that long term, but every position that I have found, aside from Facebook, I guess Facebook and Google as well, because Facebook wouldn't have been sold, but every position, dividend-wise, because Facebook did not pay a dividend at that point, and neither did Google. So every dividend position or dividend company that I have found that pays in 3, 6, 9, 12, the goal was always to say, I'm going to use Tyson Foods, I'm going to make 30% of my money, and then I'm going to put it into something else, and then I go to Visa. So at this point in my investing, journey, I just said, screw it. Why would I put money into anything else? I had a commenter the other day, or yesterday, I think, say, don't get too married to your price. If you think it's a great business, just buy it. He's right. It's like, why dance around it? Like, why not own? Like, I already missed the boat technically on Apple. I was a dumbass and should have bought that like 5 years ago. There's no reason for me to, and here's the thing, guys, I missed a couple really good opportunities in buying Apple as well. So I really screwed up. So I'm just trying to make up for my errors for that set of months. I do think AbbVie overall is going to make up for that loss, but Visa is just such a high quality company that any other company that I buy in this set of months, or essentially any company I add to the portfolio, needs to either match or beat the returns I think Visa is going to make. And honestly, there are a couple companies that don't do that don't fit that bill. I don't think it's going to come close to the overall return. Coca-Cola is not going to, outpace Visa, but those are going to be smaller positions, and there are different reasons that I own those companies. I want the consistent growth, even if it's low. I want the consistent dividend growth, and I want that to technically be my Social Security check every month. And with Coca-Cola, I believe in the brand long term. I buy it all the time. I feel like it would be a sin for me not to own that company because, shit, guys. In my house right now, there is a Coca-Cola teddy bear. There's like mugs. Like, I collect Coca-Cola memorabilia. So I feel like I should own that company, right? Because it has a place in my heart. So not every company is going to beat Visa, but every company in the 3, 6, 9, 12, or any company that I add after, being Costco right now or Berkshire, I feel like Costco is going to have a very similar return. It's going to be slower, but I think overall growth, I think it's going to do well. And then Berkshire, the insurance float is insane, so I think it would pace. So overall, guys, I learned my lesson, right? I'm not going to tiptoe around it. I'm just going to buy more shares. That's why it's a $12,000 position. Then Alphabet. Damn, that jumped up big. I bet it's still lower than my average cost. So Google jumped up $5.44. Now, guys, this is important because it's still a buying opportunity for me. But this just shows how fast the market changes, right? Like yesterday it was at 140. Like it jumped 3%. That's not a huge jump. But, this is a good, especially because yesterday the comment with one of my friends on Instagram was like, don't get married to your average cost. Somebody commented that as well on YouTube. Like, if I bought this at 170 and I'm sitting there, it's 174, I'm going to miss out on a great opportunity. Like, look, the 52-week high is $208. So you have like a $34 upside, let's say like $40 upside on Google right now. And all these people that were bashing it a week ago, when it goes to 190 to 200, when it hits that 52-week high, they're the type of people that are going to be like, I always believed in Google. Why would you ever bet against it? Well, you're the same type of, that the followers are the people that are saying sell the damn thing when it's at 170. So I'm just saying, make your own investing decisions, right? Don't follow the herd. Don't follow the headlines, right? Because those are bullshit, right? As long as the profitability of the company is intact, right? They have great profit margins, and it's a good, economically good business. You're making more money when you're buying it lower. So, I'm just excited because I get to buy more. So I'm super hyped. I want to try to see if I can squeeze buying 2 shares of Google this paycheck, but we'll see. But overall, guys, I love Google. Obviously, I post videos to YouTube every single day. So again, just like Coca-Cola, I feel like it'd be a sin not to own this company because I use it every day, as do millions of other people. So I just think I deserve to own. I owe it to myself, right, to own more Apple. So, or excuse me, to own more Google and more Apple, but more Google in this instance. So as of right now, I'm going to put Apple on the back burner and I'm going to focus on Google. That will change, and I do plan on still buying a share of Apple this month, considering that this is going to be my next Friday is my first paycheck of this month. So I could buy, say, Apple this check and then 2 shares of Google the next check. So we'll see how that strategy goes. But overall, I'm excited to buy Google at these prices, and I want to take full advantage of the drop in stock price. Then we got Costco. I'd buy it around 1,000, so I need it to drop a little bit. And Berkshire Hathaway around $500. I originally was like 400, but I did look at the insurance float, and they're actually growing pretty fast with insurance. And that's the main way that I try to value Berkshire, is by the insurance, because that's their main moneymaker. But I do love See's Candy, Dairy Queen, Borsheims is so much fun to visit when you're in Omaha too. And of course you got National Indemnity, you got Geico. So they've got just so many businesses. It's impossible to really list them all. They've got like 60 businesses that they own outright, and then they have a stock portfolio that has been shifting lately. And I think he's made a huge mistake on taking gains in Apple. I think he should have kept the equity in that business. I'm surprised they haven't actually bought Google yet too. I was super interested to see if they were going to add that, because if you look at some of the old Berkshire meetings, they talk about pharmaceuticals and how they should have bought those. He bought and sold, like, I think it was Bristol Myers Squibb and AbbVie. So he bought them, but he only held them for like 6 months, maybe a year. So it's not like he's going to get very much, like, a lot of gains or growth out of those companies in such a short amount of time. But one of the businesses that him and Charlie's passed now, but talked about is the rate of which Google charged for their ads in the early days of Berkshire Hathaway when it was online. And they said, we knew to buy it, but we missed the boat. And they still don't own it, but they own Amazon though. So, and a lot of those tech businesses are not Buffett himself. It's Ted and Todd, his lieutenants. So you can kind of tell by what type of company it is, whether or not Buffett's the one buying it, and the amount of money as well. But overall, guys, I love the insurance business. I've looked into Chubb, Travelers, Aflac. I've owned Aflac. I owned about 10 grand in Aflac. So, it's just, I would rather own an insurance business that has the insulation around it of all the other businesses, right? If there's a huge super cat, hurricane, earthquake, etc., Berkshire has cash outside of the insurance business to help cover those losses if they need to, right? And they have dividends from their stock portfolio as well. So I just love the way that Berkshire's set up, and I think they're better ready to handle something catastrophic in the insurance industry. So while other insurance companies are going to get slammed because I think that they can underestimate their reserves, I don't think that's something Berkshire Hathaway does. So with that being said, guys, I just want to say thank you so much for watching. Remember to hit the like button on this video. I've been posting every single day, and if you like it, hit the like button so I know. Also, I've been posting shorts almost every single day. Today I probably won't because I'm kind of running out of time before work. But I've been posting shorts every single day as well. and they've been doing really well. So I'm super excited about that. The channel's been growing. We hit over 900 subscribers, which is fucking insane. So I never thought, just some 29-year-old kid sharing his journey about investing would get almost 1,000 subscribers. But I'm happy that new people are checking it out. So with that being said, guys, thank you so much for watching, and I'll see you tomorrow with another Robinhood portfolio update. Take care, guys.